Alright, so you think you know finance. You opened up a Robinhood account, dropped 50 bucks into some obscure semiconductor stock, and think you're the next Michael Burry. You're not, because all you're doing is staring at tickers. Stock up, stock down, buy low, sell high. Here's the problem. None of the numbers you're staring at actually matter. The most important concept in investing is valuation. Valuation is the intrinsic value of a business, what the company is actually worth underneath the ticker symbol. Real investors spend their entire lives trying to figure out the gap between value and price for stocks. To illustrate, let's take your mom's Toyota Corolla. If I sell it to you brand new for 25K, you'd say that's pretty fair value. If I sell it to you for 5K, that's a steal. And if I sell it to you for 100K, I've lost my mind. Same car, same quality, different values. Stocks work the same exact way, except when you open Robinhood, all you see is the price. You have no idea what the thing is actually worth. So how do investors estimate value? One way is a discounted cash flow. That just means adding up all the cash a company will generate in the future and translating it into today's dollars. Another common method is public comps. You look at similar companies, take their enterprise value, and divide it by revenue. If everyone trades at 5 times and your stock trades at 10, maybe it's expensive. If it trades at 2, maybe it's cheap. Valuation isn't perfect. It's art and science. As the GOAT Benjamin Graham once said, price is what you pay, value is what you get. If you don't understand that, you're not investing, you're gambling. Thanks for watching. This has been Terminal Value. Subscribe if you want to become a real investor, and I'll see you in the next one.